In a world defined by rapid change and relentless competition, standing still is no longer an option. Strategy today isn't just about understanding the forces at play, it's about boldly opening doors to the future. In our earlier phases, we mapped the landscape, analyzing the external environment, decoding industry dynamics, and uncovering the core strength that gives our company its edge. Now, we move from insight to impact. In this final presentation, we unveil a strategy that transforms vision into action, grounded in comprehensive analysis, sharpened through synthesis, and structured for real-world implementation. The future doesn't wait. Let's build it strategically, boldly, and decisively. Let's begin. Coty Incorporated is part of the booming beauty, cosmetics, and personal care industry, valued at over $557 billion in 2023 and growing at nearly 8% annually through 2030. This market industry includes skincare, makeup, fragrances, and more alike. Coty competes with giants like L'Oreal, the market leader with $44 billion in revenue, and Estée Lauder, a strong and profitable competitor. Innovation and staying on trend are key in this fast-growing sector, driven by consumers' growing focus on self-care. We've already explored Coty's internal strengths and the external factors shaping the industry, but let's zoom out and revisit the booming beauty market they're playing in. Beginning with PESTLE Analysis. The global beauty industry is under mounting pressure from all sides. Geopolitical instability and tightening international regulations are making ingredient sourcing and cross-border operations more fragile and expensive. At the same time, the economy is shaping how people spend, with inflation squeezing wallets. Many consumers are trading down, choosing affordable alternatives over premium brands, which is redefining competition. Consumer values are also evolving fast. Beauty today is no longer just about looks. It's tied to identity, wellness, and ethics. Audiences expect inclusivity, sustainability, and authenticity. Technology is raising the bar. From AI-driven personalization to smart production systems, innovation is no longer optional. It's the baseline. But with more tech comes more responsibility, privacy risks, and digital regulation. And finally, sustainability is no longer a nice to have. With climate change threatening ingredient availability and growing consumer demand for clean, eco-friendly products, environmental responsibility is now directly tied to brand equity. In short, the industry is in constant transition. Companies that can balance innovation, ethics, resilience, and agility will shape the future, while those that get stuck absorb the risk of getting eliminated. Now for the 5 forces analysis. Looking at the cosmetics industry as a whole, the threat of new entrants is a moderate force, with brand loyalty, regulatory standards, and distribution advantages protecting incumbents despite the industry being an attractive one. Suppliers command moderately weak bargaining power, as the specialized nature of raw materials needed is offset by supplier diversity. Consumers command strong bargaining power, with large malls and retailers controlling product visibility, while direct consumers benefit from differentiation and brand variety. The threat of substitutes for cosmetics presents a weak force, since no amount of exercise or herbal medicine can combat cosmetic products' instant effects. Industry rivalry, however, is strong, with intense competition from global brands. What does it take for Coty, Estée Lauder, and L'Oreal to bring home the crown? Each is a powerhouse with its own legacy, market focus, and competitive edge. But how do they really stack up in today's fast-evolving landscape? Coty, founded in 1904, is based in New York and leans heavily into celebrity-driven brands like Kylie Cosmetics. Estée Lauder, also New York-based, is known for its prestige skincare and makeup lines like La Mer and MAC. And then there's L'Oreal, the French titan with the largest revenue base, the widest global reach, and the most diversified brand portfolio in beauty. While Coty is lean and mid-size, Estée and L'Oreal are global behemoths that each is facing unique opportunities and constraints. Quickly about its financial performance, Coty Incorporated has had its fair share of sizing up to its rivals L'Oreal and Estée Lauder. Being the underdog to market leader L'Oreal and a relatively bigger Estée Lauder, it's been indicated that they have a more efficient cash conversion cycle, with the company attaining the lowest cash conversion cycle amounts for a 5-year span. This indicates that Coty is highly efficient in managing its working capital, turning inventory into cash faster than its larger competitors, which supports liquidity and operational agility despite its smaller scale. However, other financial indicators show that Coty is more likely to be the less valuable brand compared to its rivals, with a gross profit margin metric value being the lowest for the last 5 years compared to L'Oreal and Estée Lauder. Despite that, it's still apparent that they've consistently been racking up positive values, which shows that their profit. The heart of each company is their value chain. Coty excels in influencer marketing and strategic licensing, but is still building maturity in operations and tech. Estée Lauder is highly specialized, with premium manufacturing, ethical sourcing, and a logistics system built for precision. L'Oreal, they're unmatched in R&D, scale, and digital tools, supported by ISO-certified factories and cutting-edge innovation hubs around the world. L'Oreal's chain is the most integrated. Estée Lauder offers premium efficiency. Coty runs lean and agile, but with some trade-offs in resilience. Strategically, Coty is betting on cost saving, regional expansion in China, and tech-driven forecasting. Estée Lauder is doubling down on high-margin skincare and direct-to-consumer channels. L'Oreal leads with innovation, sustainability, and AI-powered personalization, staying ahead in nearly every segment. But no strategy is perfect. Coty relies too heavily on cost-cutting, celebrity branding, and a few key markets, leaving it vulnerable to volatility. Estée Lauder faces inconsistent financials, lagging asset efficiency, and risk from its fading department store legacy. Even L'Oreal has blind spots, underperformance in male and aging markets, and a few truly inimitable resources beyond its scale. The takeaway? Every leader has a weak link. The key is how well they adapt in a beauty industry that rewards speed, innovation, and sustainability. Now let's go to future key success factors. First, innovation in product efficacy and safety. People don't just want promises anymore. They want proof. Products need to deliver real, visible results backed by science. If a brand can show clinical validation and ensure safety, it builds serious trust, earns loyalty, and stands strong against regulation. Second, speed and flexibility in product development and supply chain. Trends pop up fast and fade even faster. That's why being quick and flexible is a must. The brands that can launch new products fast and apply their supply chains in real time are the ones that stay relevant and grab the moment. Third, portfolio strength across core and growth segments. It's risky to rely on just one category. A strong portfolio spanning skincare, hygiene, and fast-growing areas like clean beauty or men's grooming helps brands stay relevant and reach more consumers across both mass and premium segments. Fourth, global reach with local relevance. Being global is great, but what really matters is connecting locally. Success means adapting products and messaging to fit different cultures, especially in markets like Asia and Latin America where preferences are unique and fast evolving. Fifth, compliance with sustainability and ESG standards. Sustainability isn't a bonus anymore, it's expected. Meeting ESG standards might not boost sales overnight, but it builds brand trust, keeps investors confident, and ensures a brand's long-term license to operate. Coty Incorporated has cultivated several core competencies that underpin its competitive advantage and drive its success. Coty manages over 50 well-known brands across fragrances, cosmetics, skincare, and body care. This broad portfolio helps Coty serve diverse consumer needs and price points, ensuring strong market reach and revenue stability. While other companies have wide portfolios, Coty has a unique mix of prestige and mass-market brands, along with long-term brand relationships. Its three-division structure supports effective brand management. This diverse brand portfolio is a key strength for Coty. Coty is organized into three focused divisions: luxury, consumer beauty, and professional beauty, each targeting specific consumer groups. This setup enables precise product development, marketing, and faster decision-making tailored to market needs. While divisional structures are common, Coty's deep alignment of category, consumer, and brand strategies set it apart. This consumer-centric design enhances Coty's agility and market responsiveness. Coty leads in sustainability and social responsibility, surpassing its emission reduction goals with an 82% cut in Scope 1 and 2 emissions. It promotes inclusivity and gender equality through initiatives like the #UndefinedBeautyMission and equitable pay. These efforts build brand trust and appeal to consumers and investors who value ESG. Achieving such results requires deep cultural and operational commitment, making this a growing core competency for Coty. These core competencies collectively enable Coty Incorporated to maintain a strong market presence, adapt to industry changes, and meet the diverse needs of consumers globally. Now let's walk through Coty's key strengths, weaknesses, opportunities, and threats to understand its current strategic position. Coty's diverse brand portfolio includes over 50 established brands across mass market and luxury segments, allowing it to reach varied consumer groups and maintain market resilience. The company is also a leader in sustainability, with half of its sites carbon neutral and ambitious goals for recycled packaging by 2025. Additionally, Coty's firm structure is well organized by category: luxury, consumer beauty, and professional beauty, enabling strong market alignment and efficient operations. Coty relies heavily on licensed brands like Gucci and Burberry, which limits its control over long-term brand equity. It has a weak presence in high-growth markets such as China, contributing only 6% of revenue there, leaving it vulnerable to slow growth in mature Western markets. The company is also slow in responding to fast-moving, trend-driven beauty segments, and has been late to enter emerging categories like clean beauty, dermacosmetics, and men's grooming. Efforts like Kylie Skin have underperformed, and it lacks a strong foothold in growing Asian beauty trends. There's significant potential for Coty to expand into underserved growth segments such as clean beauty, dermacosmetics, and men's grooming, especially with rising consumer demand for eco-friendly and sustainable products. Coty can further enhance innovation speed through agile workflows and automation to better match real-time market trends. Accelerating expansion in Asia, supported by the new Coty China Innovation Hub, presents a crucial growth avenue to reverse regional weakness. Coty faces intense competition from industry giants like Estée Lauder and L'Oreal, which dominate through strong scientific innovation and luxury brand ownership. Economic pressures like inflation and the rise of affordable dupes threaten premium brand sales. Additionally, Coty's dependence on influencer-driven marketing exposes it to reputational risks from public controversies and the volatile nature of social media fame, which can damage brand loyalty and long-term equity. In assessing success with the cosmetics and personal care industry, these key success factors have been identified, each weighted based on its influence in sustained growth and market leadership. First, innovation in product efficacy and safety accounting for 30% of the weight. This factor is crucial as it drives credibility, consumer trust, and regulatory compliance, especially in skincare and hygiene. It's measured through R&D investment as a percentage of revenue, number of patents filed, clinical trials and dermatological endorsements, and the percentage of new launches with scientific or clinical positioning. Second, speed and flexibility in product development and supply chain, weighted at 25%. 5%. Speed and agility are essential to capture short-lived demand in a trend-driven market. Key indicators include average time to market, percentage of products launched in response to current trends, supply chain responsiveness, and inventory turnover ratio. Third, portfolio strength across core and growth segments with a 20% weight. A balanced and diverse portfolio ensures sustained relevance and mitigates category risk. This is evaluated based on revenue concentration across categories, number of distinct product segments, presence in emerging segments like men's grooming or clean beauty, and the balance between mass and premium offerings. Fourth, global reach with local relevance at 15%. This factor reflects the importance of adapting to local consumer needs in key growth markets. It's assessed through a company's presence in international markets, sales contributions from Asia Pacific, Latin America, and Africa, number of localized SKUs, and region-specific marketing efforts. Lastly, compliance with sustainability and ESG standards, weighted at 10%. ESG performance is a baseline expectation that influences brand reputation and long-term viability. It is measured through third-party ESG ratings and certifications, environmental initiatives like emissions reduction, percentage of ethical sourcing, and supported social responsibility programs. Let's get into the competitive stress assessment, which will evaluate how well Coty Incorporated performs against L'Oreal and Estée Lauder across the key success factors mentioned. L'Oreal leads with a perfect 10, investing 3.5% in R&D and filling nearly 300 patents in 2023, backing products with strong science and dermatological research. Estée Lauder scores 9, blending scientific rigor in partnerships like Dr. Matthew Walker to deliver clinically proven products like La Mer and Clinique, supported by 85 patents and innovation-led revenue. Coty earns a 7, showing niche innovation but trails in R&D spending and lacks transparency in trials and patents, highlighting potential but also a gap in scientific credibility. Speed and flexibility are key in today's fast-moving beauty market. L'Oreal scores 9 for its advanced AI and large-scale infrastructure enabling rapid product rollouts. Estée Lauder scores 8, adaptive and AI-enabled, but recent inventory issues have slowed responsiveness. Coty earns a 7, showing agility with viral launches like Burberry Goddess and Kylie Cosmetics, though limited performance transparency holds back a higher score. L'Oreal scores 9, combining global scale with local relevance across more than 150 countries and dominating in clean beauty, dermacosmetics, and men's grooming. Estée Lauder follows closely, leveraging a globally diversified premium skincare-focused portfolio, strong in Asia and Europe. Coty only scores 6, strong in fragrance and color cosmetics, but limited in emerging segments like clean beauty and grooming, with untapped mass market potential. L'Oreal scores 9, excelling in over 150 countries with a decentralized model and strong cultural adaptation. Estée Lauder earns an 8 for its balanced global presence and localized strategies, especially in Asia and Europe. Coty scores a 7, present in more than 120 countries with growth in Latin America and Asia, but still reliant on EMEA and the Americas, with localization efforts still maturing. Coty leads with a score of 9, backed by an MSCI A rating, low ESG risk from Sustainalytics, and strong action on emissions, renewables, and sourcing. L'Oreal scores 7 for ambitious goals and transparency, but lacks published ESG ratings and faces sourcing concerns. Estée Lauder earns a 6, decent initiatives but only medium ESG ratings and ongoing criticism on transparency and social responsibility. The CSA Matrix revelation, L'Oreal leads with a total weighted score of 9.3, reflecting its strong performance across almost all key success factors, particularly in innovation, speed and flexibility, portfolio strength, and global reach. Estée Lauder follows with a score of 8.1, showing strengths in innovation and portfolio diversity, but facing challenges in sustainability and ethical sourcing. Coty Incorporated scores potentially with 7, having a notable image in sustainability and ESG compliance, but opportunities for growth in portfolio diversification and global market penetration. After reviewing all the information about Coty as well as its industry and rivals, we have a better grasp of where it is positioned in the market. But in order to properly gauge how to move forward with the recommendation, we need a clearer bird's eye perspective of Coty's position based on all the factors we've learned. This view comes in the form of a space matrix. We scored Coty's performance relative to itself and the industry in terms of financial, competitive, industry, and stability positions, and added the scores to form the coordinates where Coty should be focused moving forward. Based on the scores, we determined that Coty leans more towards aggressive strategies, while stability and competitive positions are driven down by their competition as well as environmental factors like inflation and technological change. Their most recent financials suggest that they can be a bit aggressive, and their industry position is favorable with good growth and profit potential. The space matrix analysis guides us in knowing what direction Coty should face. When we look back at Coty's history and performance and couple that with our direction, we came up with 3 alternative forces of action that Coty can implement given its current position. 1. Accelerate product-centric innovation. We can drive growth by launching blockbuster products through our distributors, as well as develop our own new products to respond to emerging trends. However, we do run the risk of cannibalizing our existing products, and there is also high financial risk if the new innovations don't pan out. 2. Channel and geographic expansion. We can capture a part of new growing distribution channels like TikTok, as well as expand ourselves to emerging markets in the Asia-Pacific region. But when we expand to China, one of the fastest growing markets in the world, competition will likely be high. Platform partnerships for new channels will also entail big investments. 3. Portfolio optimization. We can diversify our revenue by exploring adjacent products such as skincare supplements or makeup tools. However, we still run the risk of cannibalizing our existing products, as well as disruptions with our cash flows because of the divestitures. To measure which of the alternatives were best fit for Coty, we score them based on how they address our future key success factors. Each score is then multiplied to the weights of the respective KSF to align its impact with how crucial the factor is for Coty. The scores are then added up to find the best alternative course of action for Coty to implement. Based on the final scores, accounting for their impact on our key success factors, accelerating product-centric innovation would be our recommendation for Coty. The challenge now is on how to apply the action to our implementation. The implementation plan translates a strategic vision into actionable steps that guide execution, ensure alignment, and drive measurable results, serving as a roadmap for how an organization will achieve its objectives, detailing what needs to be done, when, by whom, and how success will be measured. It highlights 4 phases that are necessary for carrying out the primary strategy chosen by the company. First is the assessment phase. The assessment phase is made up of key activities that should be carried out by Coty for its entire duration. It involves financial assessment, which evaluates the financial capacity of being able to conduct strategy. Having this as a key action ensures that innovation efforts are not only technically feasible, but also economically sustainable. Creating and maintaining partnerships with brands, building and nurturing strong collaborative relationships with other brands and companies, ensuring alignment in terms of goals and product efficacy. Gathering stakeholder insights. People have different opinions on things, so it's important to collect varied insights from internal and external stakeholders to better understand the feasibility of the proposed strategy. The second phase, which primarily involves the development of strategy, has 2 key activities, namely assortment planning. This determines which product categories should be focused on more in terms of achieving goals. By assortment planning, it ensures that Coty's innovation efforts are directed toward the most impactful and commercially viable product segments. Develop innovation focus points and roadmap. Coty must define the scientific innovation priorities and establish a structured timeline for R&D and product development that are aligned with their strategic goals. This roadmap should be able to guide decision-making and create a unified direction for the company moving forward. The implementation of the strategy would involve the following key activities: quality assurance and quality control. Quality and effectiveness are 2 focal points of part of Coty's success, so they must consistently ensure that the innovation-driven products meet the highest standards of quality and safety. This activity underscores the importance of integrity and building consumer trust. Upskilling scientific talent. To branch out and expand the extent of innovation by fostering new technologies and discoveries, thereby creating competitive advantage. Upscaling innovation centers. This is consequential with the upskilling of scientific talent, where new spurs of innovation are fostered. Innovation capability expansion must be done. The growth of talent must be linear with the facilities provided. And lastly, for evaluation, Coty would need to be in check when it comes to maintaining the implemented activities. This involves consistently monitoring product performance to systematically track how well Coty's scientifically innovative products perform in real-world conditions across customer satisfaction, clinical efficacy, market response, and long-term quality. This ensures Coty maintains its credibility in science-backed beauty and continually refines its offerings to meet evolving expectations. Gathering customer feedback, along with monitoring how well products perform financial-wise, is the gathering of feedback from consumers, thereby adopting a customer-centric approach. This indicates that Coty is responsive to the needs of customers and is willing to make improvements for their future products. Continuous improvement, to establish an ongoing cycle of learning and enhancement that refines Coty's products, processes, and innovation strategy based on performance data, consumer insights, and scientific advancements. This ensures that Coty remains competitive, relevant, and credible as a leader in efficacy-driven beauty. The implementation plan implies a proactive and structured approach to driving Coty Incorporated's innovation goals. It ensures that scientific advancement is not just aspirational, but systematically executed, measured, and refined, positioning the company to deliver consistently effective products while remaining competitive and responsive to market needs. To keep ourselves grounded within the strategy, we will implement a balanced scorecard. For the financial perspective, our goals would be to maximize sales and attain ROI on innovation investments. Measures of these would include sales volume, revenue on innovative products, and cost of R&D. Our targets would be to increase annual sales by 6% and a 10% income generated from new innovative product lines. To achieve this, we focus on high-efficacy products, strengthen data-driven marketing, and leverage on data analytics for product assortment. We also leverage partnerships for cost sharing and track post-launch performance while enhancing collaboration between R&D and marketing. For the customer perspective, our goals would be to strengthen customer trust on products and improve responsiveness to customer needs. Measures of these would be customer satisfaction score, net promotion score, and the percentage of improvements made from feedback. Our target would be an 85% satisfaction rating, an NPS of greater than 40, and 100% of our launches with follow-up improvement plans. To achieve this, we initiate post-launch feedback programs, highlight efficacy claims through marketing and branding, initiate consumer insight tracking, and integrate feedback systems into continuous improvement. For the internal processes perspective, our goals would be to streamline quality development processes and strengthen collaboration between partner brands. To measure this, we would look at the product defect rate, the number of active brand collaborations, and co-developed product launches. We will target a product defect rate of less than 5% and target to be able to release 3 collaborated product launches annually. In order to achieve this, we will need to look at factory maintenance checks, quality assurance audits, and compliance of QA/QC standards. We'd also look at negotiations with partner brands centered around development, joint R&D planning sessions, and decentralized innovation roadmaps within brand partnerships. Lastly, for learning and growth, our goal would be to upskill and retain high-performing researchers while expanding innovation capabilities through infrastructure and technology. To measure these, we will look at the percentage of R&D staff trained in-house, employee retention score, number of innovation centers, and percentage increase in lab capacity. We target 100% training completion for staff, 80% retention in R&D staff, 2 new centers or expanded innovation centers by 2028, and a 25% increase in lab capacity across all facilities. To achieve this, we will launch annual training and career development programs, compensate fairly according to market standards, invest in the latest available R&D technology, upgrade our facilities, and invest in AI or biotech or innovation support.